Hi, Gary and Kevin here from Chicago. We have our third quarter update, and we just finished the bond buying program here on QE3. Not sure if QE4 is going to show up or not, but that's brought back a lot of volatility into the marketplace. And here very recently we tested this 10% correction, didn't quite get there. And finally, I think a lot of you want to know, what's going to happen over the next year. So Kevin, as we sit here today and we look at some macroeconomic stuff, we have unemployment at 5.9%. That's been going down. We have GDP at about 3%. Most think it's going to continue at that 2 to 3% level. We have inflation that's still running around 2%. Manufacturing is over 50, so it's still growing here in the U.S.
Consumer sentiment
is a little bit negative, but it's not positive yet. And that's one of the parts that some people are saying is why we really haven't seen the markets really take off much more so than we would expect. So when you look at the macro overview, we got, is QE4 going to happen, and what about the volatility? Can we expect that to continue?
Well, a lot of people would think that this market over the last 5 years has been under-owned. Individual investors have not been back in a big way, and that the quantitative easing, the money that the government's been putting into the system, has been having a large play in driving up the market. So a lot of your value type practitioners would say that that's not sustainable. And you look at cyclically adjusted earnings, that's another value warning, because we're at peak productivity. We've been squeezing out more profits with less labor. That's not sustainable either. That really doesn't take into account either a lot of things that are going on in this country in terms of manufacturing, energy efficiency, things of that nature. And you are seeing some signs of labor improvements in terms of income, disposable income being able to be spent in the economy, which can then take the next leg up. Bottom line is the government's been trying to keep the system going, keep some inflation going so that the economy can continue to grow on its own. On the other side of the coin, maybe taking a more stay-as-the-course approach, is we don't have the euphoria in this market. It's not at inflated PE levels if you take that these earnings are sustainable, right? And that the market has been under-owned. It's no surprise that volatility has come back with the government kind of taking money out of the system with the tapering, because it's happened the previous 2 or 3 times as well, right?
Exactly.
So you mix that all together. I'd like to know what the next year is going to bring as well. But when you're sitting here with 2% dividend yields comparable to what the 10-year Treasury is, and as we mentioned in previous updates, it's the only game in town. Well, but stock market goes up because companies improve earnings. Stock market goes up and down based upon fear and greed and emotion, as well as the prospect of recession, right? I don't know if I could paint that negative course of seeing a recession. We haven't had, how long has it been since we've had a 10% correction to have a cleansing?
Couple of years.
Which would traditionally be the next leg up. So that's kind of a roundabout kind of an answer in terms of we're pretty much where we were where we talked last, is that we feel you're comfortable maintaining your equity allocations, having an eye to look to add on opportunity, and continuing to watch for signs of would there be a market top, a crisis coming up, a pandemic, things of that nature. That, like in any time we said before, if you own stocks for a long-term objective, they can go down 20% at any time.
Right. So we had almost a 10% correction, and that was brought on somewhat through the third quarter, where S&P was up 1.1%, small caps were down 7.4%, international developed countries were down 2.2%, and emerging markets were down 3.4%. But this big money poll comes out recently from Barron's, and these individuals are saying 59% of them are bullish. 2/3 of them are saying the market's going to go up 10 to 15% over the next year, but also 2/3 of them say that we're probably going to expect a 10% correction. So there's
well, that was the law of averages, because that study was probably taken before last week. So I mean, it's going to happen. I mean, any market rally, you go 5 years with 125% increase in the stock market, right? You're going to see a decline at some point in time in the way, and hopefully that draws in new investors and it brings for the next leg up. Another interesting point that I don't think we've raised so far in this update is, while the market was up 8% or so at the peak, the average stock wasn't. And in the decline we've had since then, like the Russell 2000, was down maybe 12, 15%. at one point since its peak earlier in the year, and the average stock is down much more than 20%.
Right.
So, a lot of that technology and biotech and things of that nature that was up big
Right.
over the last 3 or 4 years. Well, what goes up comes down as well, right? They get a little ahead of themselves, and then they hopefully brings the next leg up.
Yeah. So we're looking forward to the next year, but what we got coming up right now is we've got the November elections coming up. We don't know about QE4. Hopefully this market will move positively into the end of the year. When we come back in January, we'll see how that works and what changes in Congress have taken place, and what changes in the economy and the markets have taken place. And hopefully it's a good report card that everybody receives at the year end. So until next time, have a great holiday season.